What if I told you that in 2026, your credit score could drop even if you never miss a single payment? Sounds crazy, right? But that's exactly what's starting to happen as new credit scoring changes quietly roll out across the United States. Millions of people who think they're doing everything right could suddenly see their scores shift sometimes overnight. And here's the scary part. Most people won't even realize what caused it. From buy now pay later accounts being tracked more closely to new ways lenders measure your spending habits, the rules of the game are changing fast. So if you're planning to apply for a loan, buy a car, rent an apartment, or even get a credit card in the next couple of years, this is something you cannot afford to ignore. In the next few minutes, I'm going to break down exactly what's changing, why it matters, and how you can protect yourself before it's too late. Now, before we jump into the changes, let's quickly understand why your credit score is such a big deal in the first place. Your credit score is basically a three-digit number that tells lenders how risky it is to lend you money. The higher your score, the more trustworthy you look, and that means better interest rates, higher credit limits, and more financial opportunities. But if your score is low, even by a small margin, it can cost you thousands of dollars over time or even get you denied completely. Traditionally, your score has been based on factors like your payment history, how much of your credit you use, the length of your credit history, and the types of accounts you have. Simple enough. But in 2026, these factors aren't just being used differently, they're being expanded, refined, and in some cases, completely redefined. Lenders are no longer just looking at whether you pay your bills. They're analyzing how you behave financially over time, with much more detail than ever before. And that's exactly why these upcoming changes are so important, because they could either boost your score faster than ever, or quietly drag it down without warning. So let's start with the big question. What exactly is changing in 2026 when it comes to credit scores? For years, the system has been relatively predictable. Pay your bills on time, keep your balances low, and your score goes up. Miss payments or max out your cards, and your score drops. Simple. But now, the system is evolving, and it's becoming much more behavior-focused, rather than just snapshot-based. Instead of just looking at your current credit usage, newer scoring models are starting to track trends over time. That means lenders aren't just asking, "What's your balance today?" They're asking, "How have you been managing your credit over the past months, or even years?" One of the biggest changes is how credit utilization is evaluated. Earlier, if you kept your usage low at the time your statement was reported, you were in good shape. But now, if your balances frequently spike, even if you pay them off later, that pattern could still hurt your score. This introduces a whole new level of discipline borrowers need to maintain. It's no longer about gaming the system, it's about consistent financial behavior. Another major shift is around medical debt and collections. Recent trends show that smaller medical debts and paid collections are having less impact on scores, and this direction is expected to continue into 2026. That's good news for many people who are previously penalized for unavoidable expenses. However, don't assume all negative items are disappearing. Larger unpaid debts will still matter a lot. Also, scoring models are becoming more data-rich. They're pulling in more detailed credit behaviors, meaning your financial habits are being analyzed more deeply than ever before. This doesn't necessarily mean the system is unfair, it just means it's smarter. The gap between responsible and risky borrowers is becoming clearer. So overall, the 2026 changes are less about completely new rules and more about smarter evaluation. And if you're not paying attention, these subtle shifts can have a big impact on your financial future. Now, let's talk about the changes that are catching people completely off guard, because these are the ones that can quietly impact your score without you even realizing it. One of the biggest surprises is the growing influence of buy now, pay later services, often called BNPL. These platforms have exploded in popularity over the last few years, letting people split payments into smaller chunks without traditional credit cards. It feels harmless, even convenient. But here's the catch: these accounts are starting to be tracked more closely and may increasingly factor into your credit profile. That means if you're juggling multiple BNPL purchases at once, it could signal risk to lenders. Even if you're making payments on time, the sheer number of active short-term obligations might work against you. It's a shift from how these services were originally perceived, and many users are not prepared for it. Another surprising change is how fast your credit score can update. With advancements in reporting systems, credit data is becoming more real-time. Instead of waiting weeks to see an impact, Changes in your balances or payments can reflect much faster. That means mistakes can hurt you quicker. But on the flip side, good habits can also boost your score sooner. Then there's the rising importance of alternative data, like rent and utility payments. Traditionally, these didn't play a major role unless you used specific reporting services. But now, there's a growing push to include these factors more broadly. This is great for people who don't use much credit but consistently pay their living expenses on time. It gives them a chance to build a stronger profile. What makes all of this surprising is that these aren't behaviors people typically associate with credit scores. You might think skipping a credit card payment is risky, but using too many BNPL plans or ignoring rent reporting could also shape your score now. And that's exactly why awareness is everything. With all these changes, not everyone is affected equally. In fact, the 2026 credit system is creating a clearer divide between people who manage their finances consistently and those who rely on short-term flexibility. Let's start with the winners. If you're someone who pays all your bills on time, keeps your credit card balances low, and avoids unnecessary debt, these changes actually work in your favor. Why? Because the system now rewards consistency more than ever before. It's not just about doing the right thing. Once it's about doing it over and over again. People with stable financial habits will likely see their scores improve faster and stay strong. Even better, if rent and utility payments are included more widely. Individuals who have been financially responsible outside of traditional credit systems finally get recognized. This opens the door for millions of people who were previously invisible to lenders. Now, let's talk about the losers, or more accurately, the people who need to adapt quickly. If you're someone who frequently carries high credit card balances, even if you pay them off eventually, you might start seeing negative effects. The same goes for heavy users of buy now, pay later services. These platforms can create the illusion of control while actually increasing your overall financial exposure. Another group at risk is people with thin credit files. If you don't have much credit history and you're not using alternative data like rent reporting, you could fall behind in this new system. Lenders are looking for more data, not less. The bottom line is simple. The system is no longer forgiving inconsistent behavior. It's designed to reward stability and penalize unpredictability. So depending on your habits, you're either going to benefit or you're going to need to make some serious changes. So the big question is, what should you actually do to stay ahead of these changes? The good news is that you don't need complicated strategies or financial hacks. What you need is consistency, awareness, and a few smart adjustments starting right now. First and most important, keep your credit utilization low at all times, not just when your statement closes. Aim to stay below 30%, but ideally under 10% if you want to maximize your score. Since trends over time now matter more, you can't rely on last-minute payments to fix things. Next, be careful with buy now, pay later services. They're not inherently bad, but overusing them can create multiple active obligations that lenders may view as risky. Treat them like real debt, not free money. If you already use them, keep the number of active plans minimal and manageable. Another key move is to never miss any payments, no matter how small. Even minor bills can play a bigger role as reporting becomes more detailed and real-time. Set up auto payments wherever possible to eliminate the risk of forgetting. You should also start monitoring your credit regularly. This helps you catch errors, track your progress, and understand how your behavior is affecting your score. With faster updates, this becomes even more valuable. Finally, consider adding alternative data like rent payments to your credit profile. If you consistently pay rent on time, this could give your score a meaningful boost under newer models. The reality is, 2026 isn't about sudden changes, it's about smarter systems. And the people who win are the ones who prepare early. If you start building strong habits today, you won't just survive these changes, you'll benefit from them. So here's the bottom line. 2026 isn't bringing a completely new credit system, but it is changing how the game is played. The rules are becoming smarter, stricter, and far more focused on your real financial behavior over time. That means you can no longer rely on quick fixes or last-minute tricks to boost your score. Instead, consistency is going to be your biggest advantage. If you've been managing your money wisely, keeping your balances low, and paying everything on time, you're already in a strong position. But if you've been relying on short-term habits like high credit usage or stacking buy now, pay later plans, now is the time to rethink your strategy before these changes fully take effect. The most important thing to remember is this: your credit score isn't just a number, it's a reflection of your financial habits. And in the coming years, those habits will be analyzed more closely than ever before. The good news is, you're not too late. In fact, you're early. By understanding these changes now, you've already put yourself ahead of millions of people who won't realize what's happening until their score drops and it's too late to react. If you found this helpful, make sure to subscribe, because I'll be breaking down more strategies to help you build, fix, and grow your credit step by step. And I'm curious, what's one habit you think you need to improve to protect your credit score? Drop it in the comments below. In the next video, I'm going to show you exactly how to boost your credit score as fast as possible using simple, proven methods, so don't miss that.